investing $365 either way, daily $1 or annual $365, sounds like the same math. But one method produces dramatically different results. A $100,000 lump sum investment at the start of 2009 grew to approximately $1,083,000 by 2025, while monthly dollar cost averaging over the same period reached $892,000. A $191,000 difference that hints at a counterintuitive mathematical advantage hiding in market volatility. The difference becomes exponential when you extend the timeline. Using the S&P 500's 11.5% average annual return over the past 40 years as a baseline, a daily $1 investment, $365 annually, compounded monthly produces $246,000 after 30 years. The same $365 invested once per year with identical returns reaches only $217,000. That $29,000 gap emerges because daily contributions begin compounding immediately, capturing an additional 11 months of growth on each deposit. Earlier contributions compound longer, transforming what appears identical into dramatically different wealth accumulation over decades. The 2025 to 2026 market environment reveals how this mathematical advantage compounds during volatile periods. When markets swing wildly, as they did during the significant volatility in 2025, daily investments automatically buy more shares when prices are low and fewer when prices spike. Annual lump sum investors face pure timing luck. Someone committing $365 in April 2025 caught the S&P 500's 12% drop following tariff announcements, then rode the 9.5% rebound, while January investors might have hit different timing entirely. This timing variance disappears with daily investments, which smooth volatility through systematic purchasing regardless of market conditions, transforming chaotic price swings into mathematical advantage. The S&P 500 generated a total return of 17.9% in 2025, finishing up 16.47% year-to-date with dividends, but the path included dramatic swings that created vastly different outcomes for different timing strategies. Shifting trade policies and fluctuating tariffs triggered volatility in the early months of President Trump's second term, though markets have since recovered. In April 2025, the S&P 500 experienced significant volatility, initially dropping by -12% following President Trump's tariff announcements, only to rebound by +9.5% after a pause on reciprocal tariffs. Would you rather have invested your full $365 right at that April peak or spread it daily through those wild swings? Dollar cost averaging's mathematical edge deepens when behavioral psychology enters the equation. Willpower fails, systems work. Daily investing removes human decision-making entirely through automation, while annual investing demands sustained discipline across 12 months. Research on habit formation shows this distinction matters. People consistently underestimate their own inconsistency. Annual savers frequently skip years during market downturns, reduce contribution amounts when expenses arise, or abandon strategies entirely during stress periods. Daily automation eliminates these failure points by converting investment discipline from repeated conscious choice into mechanical process, one that continues regardless of market conditions or personal circumstances. The behavioral gap between intention and execution explains why theoretical plans often collapse in practice, while automated systems persist. The mathematical reality becomes stark when projected across generational timelines. A $246,000 portfolio after 30 years of daily $1 investing maintains approximately $101,000 in today's purchasing power at 3% inflation, while the $217,000 from annual investing translates to roughly $89,000 in current dollars, a $12,000 real wealth gap that widens dramatically over 40 years. Extended to retirement horizons where you need $50,000 annually today, but $90,000 in 20 years for identical lifestyle, the compounding advantage of daily contributions becomes generational, the difference between financial security and erosion of standard of living. At 40-year timelines, this $29,000 nominal gap compounds into $40,000 plus in real purchasing power advantage, transforming what appears as modest mathematical edge into the distinction between preserving wealth across decades or watching inflation silently consume it. Automation platforms make daily investing effortless in 2026. Interactive Brokers leads with fees under 0.1% annually and minimum requirements often around $1 to $50 for regular investment plans, especially with fractional shares. Recurring investment plans handle purchases and money transfers automatically. Most brokers offer daily, weekly, monthly, or quarterly scheduling with fractional shares for maximum flexibility. Robinhood provides free U.S. stock and ETF trading with mobile-first account opening. Modern apps integrate micro-investing seamlessly through automated roundups or direct payroll integration, removing friction from consistent investing even with small amounts. The barrier to entry has collapsed. You can automate $1 daily investments into S&P 500 ETFs with zero commissions, capturing the mathematical edge that transforms modest consistency into generational wealth accumulation over decades. This mathematical advantage isn't theoretical, it's measurable, repeatable, and amplified by market volatility. The data from 2025's turbulent year proves that systematic daily investing doesn't just smooth out timing risk. It converts market chaos into compounding opportunity. Whether you're starting with $1 daily or scaling up, the principle remains. Consistent automation beats perfect timing every time. The technology exists, the costs have disappeared, and the mathematical edge is waiting. Hit subscribe for more math that breaks investing myths. Our next video reveals the compound interest mistake everyone makes.